Welcome back to Yahoo Finance Live. Arc Technology, a full-service finance platform for startups, along with Stripe, recently launching Arc Treasury, which will allow startups to easily tap into their future revenue streams to access non-dilutive capital, deposit funds, and instantly deploy spend to drive growth, all through one fully integrated digital platform. To discuss more of how this works, let's bring in the CEO of Arc. We've got Don Muir. And Don, it's good to talk to you today. Let's start by talking about how this all works.
Hey, thanks for having me. Arc is on a mission to help startups grow by providing broader access to capital. As you mentioned, for the first time ever, startups can seamlessly convert their future revenue into upfront capital, deposit those funds into a virtual bank account, and then we'll help you manage and spend that capital to drive more efficient growth.
Okay, so Don, I guess, is this kind of an advance in some respects? Like, what would be a use case for a company looking for financing to turning to this sort of alternative structure as opposed to maybe the traditional VC process?
Definitely. We're living in unprecedented times in the tech ecosystem. As equity becomes more expensive, driven by lower valuations in the venture capital markets, startups are in droves looking for non-dilutive sources of capital to extend the runway, invest in growth without incurring any incremental dilution or traditional debt. We're there helping startups grow by providing instant access to capital by converting their future recurring revenue streams into upfront capital at the click of a button.
With that said, Don, it's kind of an interesting time, right, to be with startups. We've heard a lot about the slowdown in fundraising, maybe not necessarily at the early stage, but the later stages as well. I mean, how does those future revenue streams look like right now?
Definitely. Well, our portfolio is doing great. We're investing in explosive growth companies that are facing unparalleled times in the public equity markets. The Bessemer Cloud Index is down 50%. We're seeing record inflation, interest rate hikes. And as that equity becomes more expensive, startups are forced to either raise at a lower valuation or incur very costly debt that's burdened to the balance sheet. So we're seeing founders come and access capital through alternative sources of funding. With Arc, again, we're converting future revenue streams into upfront capital. So it's technically non-debt. We don't take any ownership stake, so it's non-dilutive, and we can help startups weather this storm and get to the other side and ultimately raise at a higher valuation the markets come back.
Okay, so then what's in it for you and Arc? How do you make this a profitable? I mean, because it sounds like a pretty good deal for a company trying to do fundraising. You've got over 100 startups working with Arc, but how do you make sure that you can get keep the lights on?
Yeah, the most typical response we're getting from founders in this market is, it sounds too good to be true. The reality is we take a small take rate that's dynamically priced based on the risk profile of the company. So we'll ingest raw financial data from our startup customers and run that through our algorithm. And the model produces funding terms for these startups, which prices that risk. So we'll say we'll take anywhere from a 5 to a 10% take rate to convert those future revenue streams into upfront capital today to invest in growth, to pull forward hiring plans, or simply to weather the storm by shoring up the balance sheet to get through these challenging times.
All right, Don Muir, Arc Technology CEO, thanks so much for the time today. Really appreciate it.